All right, let's talk mortgages. But we're not going to get bogged down in just interest rates and down payments. No, we're going to pull back the curtain and look at the entire system. All the rules and tools that are really designed to manage one critical thing: risk. Let's dive in.
I mean, really think about this for a second. How does a bank feel comfortable handing a total stranger $500,000 and saying, okay, see you in 30 years? The answer? It's all because of this incredibly sophisticated system of rules, tools, and safety nets that makes that kind of trust even possible.
So here's how we're going to break it all down. We'll start with two core philosophies that every loan is built on. Then we'll walk through 3 different toolkits that lenders use. After that, we'll learn some of the lingo before we put it all together to see the big picture.
Okay, so first things first. Every single mortgage out there starts with a choice between one of 2 big ideas, 2 different ways of thinking about how to manage risk. It's like the first fork in the road for any loan.
On one side, you have what's called a qualified mortgage, or QM. You can think of this as the rulebook approach. After the 2008 financial crisis, the government put in place these standards to make sure borrowers could actually afford to repay their loans. On the other side is the non-QM loan. This is way more of a flexible, case-by-case approach for people whose finances don't quite fit into that standard box.
So these QM loans have some really specific guardrails. They're designed to avoid super risky features, like interest-only payments or loan terms that stretch out past 30 years. And these rules, they're not just there to protect the lender from a default. They also protect you, the borrower, from getting into a loan that you can't actually handle. It's all about making things predictable and safe for everybody.
Okay, so with that foundation in place, let's get into our first and by far most common set of tools. These are the loans you're probably going to run into the most: conventional and conforming loans.
A conventional loan is pretty simple. It just means it's not backed by the government. Instead, the rules of the game are set by 2 huge players you've probably heard of: Fannie Mae and Freddie Mac. Now, they don't give out loans themselves. What they do is buy loans from the lenders, and that frees up the lenders' cash so they can turn around and make more loans. It's what keeps the whole system moving.
And that brings us to a really important split inside the world of conventional loans. See, if your loan is under a certain size limit set by the government, it's called a conforming loan. That means Fannie and Freddie can buy it. But if the loan is too big, it becomes a jumbo loan. It exceeds those limits, so it has to be funded by private investors. And that's exactly why jumbo loans usually have much stricter rules.
But what happens if you don't quite fit that conventional mold? Well, that's where our next toolkit comes in. These loans have a built-in safety net from the US government, all designed to help more people get into a home.
And you've got 3 main players on the field here. Each one is designed for a very specific purpose. FHA loans for just making homeownership more accessible, VA loans for veterans and service members, and USDA loans for people in rural areas.
FHA loans are probably the most common government-backed option. Here, the Federal Housing Administration basically insures the lender against a loss, and because the lender has that protection, they're willing to offer mortgages to people who might have lower credit scores or smaller down payments, sometimes as low as just 3.5%.
Next up is the VA loan. And honestly, this is just an incredible benefit that people earn through their military service. The Department of Veterans Affairs gives a guarantee to the lender, and that guarantee unlocks some seriously amazing features for folks who are eligible.
And this right here, this is the most powerful feature of all. For most eligible borrowers, the required down payment on a VA loan is 0%. 0%. That is a total game changer, and it opens the door to homeownership for so many people who have served our country. And rounding out our government toolkit is the USDA loan. This one is specifically geared towards boosting homeownership in rural communities. For the right borrowers in the right areas, this program can also mean 100% financing, which, means no down payment at all.
Now for our third toolkit, the custom one. This is for all those unique situations we talked about, the ones that often fall into that non-QM category. And the best example here is the adjustable rate mortgage, or ARM.
To understand how an ARM works, you really only need to know 2 parts. The first one is the index. This is just a public market interest rate that the lender has absolutely no control over. It's the base rate that floats up and down with the market.
The second part is the margin. Now, this is the lender's piece of the puzzle. It's a fixed percentage that they add right on top of the index. And unlike the index, the margin is locked in. It never, ever changes for the entire life of your loan.
So you put them together, and you get this super simple formula. The floating index plus the lender's fixed margin equals your total interest rate. And that's it.
That's the basic mechanic behind how an adjustable rate mortgage actually works.
Okay, we've got the philosophies, we've got the toolkits. Now, let's do a quick lightning round to make sure you can speak the language of mortgages. Time to decode some of these essential acronyms.
First up, LTV, which stands for loan to value. This is just a fancy way of saying how much of the home's price you're borrowing. So an 80% LTV means you put 20% down. From a lender's point of view, a lower LTV is always better because it means you have more of your own skin in the game.
Next is DTI, or debt to income. Now, this one is huge. This number compares all of your monthly debt payments, and that includes your potential new mortgage, to how much you make each month. It is probably the single most important number lenders use to figure out if you can actually afford this new house payment.
And finally, we have APR, the annual percentage rate. Now, it's really important to know this is not just your interest rate. APR is the true cost of the loan because it includes your interest rate plus all the other fees and charges. So when you're comparing loan offers, looking at the APR is the only way to get a real apples-to-apples comparison.
So let's take a step back and look at the big picture here. All of these different philosophies and toolkits and terms, they all come together to create this one comprehensive system. It's a dynamic framework that's built to answer that very first question we asked.
It's a complex but really smart system for managing risk that lets lending happen on this massive scale. And that leaves us with one last thing to think about. This system isn't set in stone. As our economy changes, as our idea of what homeownership even means evolves, how are these rules and tools going to have to change with it?